Experts say that the Uganda government's overbasing on borrowing from local market is the main reason behind the high interest rates. Dr. Joshua Mutambi, the Commissioner for Price and Marketing at the Ministry of Trade and Cooperatives, has therefore urged the youth to take use of the government's microfinance support programs to boost their small businesses rather than taking out loans from commercial banks and fail to pay them back.
Of course, the commercial banks, those ones, the interest rate is a bit high. But government has tried to reduce on the CBR rate so that the interest rates can also be lowered. So it is a progressive thing, of course, but that's why we encourage the youth to take up the government programs. The Agricultural Credit Facility, the Small and Medium Recovery Fund, and other microfinance support center programs, because those ones, the interest rate is a bit reduced.
The Bank of Uganda has always hinted on the idea of regulating interest rates as commercial banks continue to charge high rates even when the central bank rate is cut. However, executives say that the cost of doing business largely determines the level of interest rates.
Interest rates is a work in progress. Interest rates will continue together with other industry players, the government of Uganda. The key thing is to try and lower the cost of doing business across, whether it is our customers, whether it is banking business, and that way then the cost of finance will come down.
I think we should absolutely agree that the general interest rates in Uganda are high, and it is a makeup of the economic fundamentals. You know, it is about liquidity, it is about cost of liquidity. It is at what rate, you have government borrowing, for example, treasury bills, treasury bonds, their rates are anywhere from 14% to 16, 17%. So the cost at which SMEs can borrow is definitely difficult. That is why we work with programs. So we work with sometimes our anchor clients.
According to data from the Monetary Policy Statement for April 2023, the Bank of Uganda assessed that even though inflation is declining, the risks to the outlook remain high with considerable uncertainty. The Bank of Uganda therefore maintained the central bank rate at 10% to contain inflationary pressures while at the same time supporting economic recovery. Sanche Rugan, CEO, Standard Chartered Bank, believes that if the Bank of Uganda and the Ministry of Finance maintained to contain inflationary pressures, interest rates will finally come down.
Everywhere the interest rates are very high because the global economic fundamentals have changed. Inflation rate is high. If you don't arrest it through interest rate mechanisms, it's going to be very chaotic. So what we need to do is we need to arrest the inflation. We need to start seeing that coming down. We need to reduce our borrowings gradually, which is what the PSST is doing. If you've seen, between him and central bank, they're putting up, monetary measures, fiscal measures. So I'm hopeful that we'll soon see some reduction in interest rate. How fast that can happen? Remember, we are part of a global challenge. I spoke about this earlier. There's so much that is volatile in this world. So a quick shock either way is not very exciting. So gradually, I see that the rates will come down.
The government has tried to put a number of programs to address this challenge. You are aware of the Small and Medium Enterprise Recovery Fund, which the interest rate is about 10%. It was sharing from the banks and the government.
The Bank of Uganda Monetary Policy Statement for April 2022 again maintains that the Ugandan banking system is well capitalized, highly liquid and well placed to absorb the emerging interest rate shocks and to continue providing credit to the economy. However, there is a need to continue monitoring as the events continue to unfold for any development that could trigger a risk of sentiment from emerging and frontier markets. Pedson Mumbere, Smart 24 TV, Business Today.